Hello, everybody. This is Alan Elman, the Blue Collar Investor, welcoming you to this BCI podcast number 126, titled Analyzing the Status of a Rolling Down Trade. We're going to be using a real-life example with Williams Sonoma Inc., which trades on the New York Stock Exchange under the ticker symbol WSM. Let's just start by describing what a rolling down covered call trade involves. Well, after we buy the stock and sell the call option, we then buy back the short call at the of the current option contract, and that's known as buy to close or BTC on the broker trading platform. Then we immediately sell a lower strike with the same contract expiration date, and that's known as sell to open or STO. So after we initially sell the covered call, we buy to close, and then we sell to open at a lower call strike with the same contract expiration. This will result in a time value credit. However, it will also lock in a maximum share price at the new, which is a lower covered call strike. We generally reserve the rolling down strategy for the latter part of our covered call trades. So for example, if it was a 4-week contract, we'd reserve it for the 3rd and 4th weeks. A 5-week contract, we would reserve it for the 4th and 5th weeks. Let's now turn to a real life example, a 1-month trade with WSM. And this is shared to me by a premium member who purchased 100 shares on 11/18/2020 at 110.55. Then immediately sold STO, sell to open, the December 18th, so 1 month out, 2020, 115 out of the money call, higher than current market value, at a premium of $2.45 or $245 for the contract. Now, what happened? On 12/9, the price declined to 104.87. And at that point in time, a buy to close limit order was initiated for that December 18th 150 call, and it was repurchased at 45 cents. So it was higher. It was closer to the 20% guideline, although we were more in 10% territory. But again, these are guidelines. So that's what happened. It was initially sold at $2.45 and then bought back at 45 cents. Now, at that same time, after it was buy to close, we then sell to open. And we went down with the same expiration of 12/18, but a lower strike, 105. So we went from the 115 to the 105 strike. And that generated a premium of $2.60. And that concluded a rolling down exit strategy. So we're going to take a look now and see what is the status of this trade on 12/9 after that rolling down procedure was completed. Well, using the multiple tab of the BCI covered call calculators, we can go from top row down. There's 3 rows here. In the top row, we see the initial trade structuring. WSM purchased at 110.55. Those of you watching this podcast, you could look at the screenshot. Those of you listening to it, I will describe it in detail. So in the blue cells on the left, we enter the information, 110.55, selling the out of the money 115 strike at 245, a 1-month expiration. Now our break-even price point is 108.10 when the trade was initially structured, where a 2.2% initial time value return was generated with the possibility of another 4.0% if WSM moved higher to the 115 strike. Well, we know now that it didn't do that, but that's how the trade was initially structured. Now, the second row shows that after the trade was, the short call was bought back, we had to spend 45 cents. So that 245 dropped down to a net option credit of $2. And now our break even moved to 108.55. And the return on the option before reselling the option was 1.8%, with that same upside potential of 4.0%. Again, we know that didn't happen. Now, what happened is we immediately rolled down to the 105 strike. Notice the strike got much lower from 115 to 105, and that generated a premium of 260, which made our total net option credit now $4.60. Now that moved our break even down to 105.95. And our actual return on our option, along with the share depreciation, resulted in a ROE of minus 0.9%. Of course, the stock loss was locked in at 555. That was the best case scenario. Remember, we purchased it at 110.55, and now we sold the 105 strike, meaning we have the best case scenario, a loss of 5.02% from 110.55 down to 105 on the stock side. So the option credit after rolling down was 460, which represent a credit of 4.16%. Net with the share loss and the option credit at that point in time, we had a net loss of minus 0.9%. Now, nobody likes to lose money, but certainly better to lose a lot less money having used these exit strategies than not having used them at all. Let's summarize. Rolling down is an excellent exit strategy for covered call writing when share price declines, especially in the latter half of a contract. The first half of the contract, we'd be more likely looking to hit a double or generate a second income stream by reselling the same option. That didn't happen in this case. Now, what did happen was by implementing the rolling down exit strategy and the covered call initial trade structuring, a potential loss of 5.02% on the stock side was mitigated down to a loss of 0.9%. So losing anything is no reason to break out the champagne. However, isn't it much better to lose 0.9% than to lose 5%? Obviously, the answer is yes. Now, calculations can be accomplished by using the multiple tab of the BCI calculators. Finally, I want to mention our BCI package, which is our best and most comprehensive educational product ever offered by the blue collar investor. Folks, if you want to master these low risk option selling strategies, covered call writing, selling cash secured puts, this package, 18 items, has everything you will ever need. You will need nothing else. It contains 6 online video courses with downloadable workbooks, 6 calculators, all developed by the blue collar investor and therefore found nowhere else, 5 of our best-selling books in ebook format, and we hold the #1 slots on both covered call writing and selling cash secured puts, and 13 months of our annual premium membership, which by itself has over 200 videos, expanded calculators, and our continuous online and never-ending training programs. Where can you get information on this? Go to our BCI package on our website, www.thebluecollarinvestor.com, and click on the link at the top that says BCI package. You can also purchase our items individually by going to our store, www.thebluecollarinvestor.com/store. They can be purchased individually, but if you purchase them as a total package, you get a 25% discount. Ladies and gentlemen, thank you very much for taking the time to listen to and perhaps watch this BCI podcast number 126, analyzing the status of a rolling down trade. Folks, I hope you enjoyed this presentation, and more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.